Okay, we're going to have 4 separate sessions. And let me show you exactly. Of course, we do have to discover that there is risk in trading. As you know, in fact, it's a very high level of risk. So trading is not suitable to everybody. And past returns are not necessarily indicative of future results. So everyone understands this, but there is something else that I will be discussing basically from time to time. This is known as the hypothetical trading. Hypothetical disclaimer. I use a lot of research in using my TradeStation. And so I create a lot of statistical information. It's hypothetical because when you try to do a back test, you have to look at not, a week's worth of trading. I know Ray talks about doing 100 trades. When I'm back testing a particular strategy, I'm going back at least over 1,000. And I'm going back in regards to time-based charts anywhere from 1 to 5 years. So when you do that, it's hypothetical because you have to go back test based upon historical prices. And don't feel badly, everybody who does any research does the same thing. All right, here's what we're going to do as far as the next 4 sessions. I'm going to discuss the Google Drive, where a lot of our materials are there. I'm going to overview where your basically different things that we have in the Google Drive is available to you. I'm going to be talking, of course, our chart type, and what we normally see in our room is tick charts, and I'm going to give you the settings for our tick charts. And then I'm also going to say that we have 2 indicators that we use regularly. Of course, that's moving averages, and then the 2 indicators at the bottom. That is known as the stochastics. In this particular case, we're talking about 2 of them. And then an MACD, what Ray calls the platinum, and I'll talk about the difference between the standard MACD and his MACD Platinum, which is a 0 lag MACD. And then at the end of this session, we're going to be talking about the T1 candle, and what's that white candle, and we'll talk about how that is created. We'll also, as I show you, on Wednesday, sorry about this, on Wednesday is when I'm going to review our trend following strategies, which is our 34 Bs, and the B stands for bounce, bouncing from the touch of the moving averages. So we have a 34, 89, 200 moving average, and then I'm going to be talking about the T2, T10, and the T25. They're separate strategies, but they are in the direction of the trend. Then I'm going to be discussing again the T20, what is known as the T20-1. Now this is the moving average crossover approach, which has been used for decades. But I want to show how we use that in our different charts, very much so. Yes, these are all recorded. In fact, I'll give you some more information, Peter, in just a second about where you can find that now. Then we'll so you can see we have a various number of strategies, and that's what we're going to be talking about in the next 4 weeks. And then, of course, we'll be talking a lot about what I call the classic chart analysis, the use of trend lines, what's known as flags, and what's known as ABC corrections, etc. And of course, I really want to talk about money management and the psychology of trading, which is very important. All right, here's what the first thing When you do log in to your members area, username, password, and this is what you're going to see. You're going to see a link for the Google Drive. And when you come in, you're going to go into the Google Drive, you're going to see the members only area. Now these are all folders. And in a little bit, I'm going to talk about what you can get into these particular areas. We have one folder, what is known as the Tuesday and Thursday folder. So when you click on that, there is an Excel sheet that has a link of all the webinars that we have created and put on our Google Drive in regards to our Tuesday and Thursday training session. Now these links are all to YouTube, so you should be able to review that at any time. So that is basically the folder right here, Tuesday and Thursday folder. You are now going to see the John Shealy PowerPoint and in that folder. When you click on that, this is very important, and I'm going to show this in just a little bit here, what this is going to look like. Now this is very important. So here you go. You're in the members area and click on the John Shealy PowerPoints. And this is what you have. I have a printable PowerPoint. And the reason I say it's printable because I put a white background in the charts as our examples. Therefore, you're going to run up your ink trying to paint it and basically to put it on your, so it's my suggestion is come in, download it, print it. I'm going to be, of course, talking about how we use that, but you're going to see all the rules, all the examples of our particular strategies. So you can take some time and download them. My suggestion is to print them. And I tried to make it as friendly as possible for you to be able to do that. Now, the other thing that I have is what is known as the John Shealy videos. Click on this. You're going to see very different, basically an Excel sheet again, and these links are YouTube's. Now I am going to suggest a few things. First, I created a series of 10 videos, but they're short. It's not like you're going to be taking hours away here. This gives you an idea of the general idea of what we're doing, why we use certain moving averages that we use, why do we use certain tick charts, what are some of our general strategies, such as what is known as swing trading, or bounces, basically corrections in the defined trend. So this is a good way to look. Also, I have some videos that are relatively short. Now, recently I did one called Average True Range. And again, you can just click on the link and it is going to then be able to review that. I also created a lot more. You're going to see a lot more. Basically, it's, for example, some of our members asked for about an MIT. What is it for, how is it used, etc. So I created a little video for that. I'll be doing a lot of videos within the next several weeks and of course in the future. Now this will be very interesting for those who basically, like you say, I can't watch the recording. I have already, we've had this series more than once. I have series 1, 2, 3, and 4. is the same information we'll be discussing today, Wednesday, on a following week, Monday and Wednesday. If you want to review that, they're right here. Series 1, 2, 3, and 4. Today we're actually working on Series 1. So we're going to be talking about certain strategies here in regards to the T1s. And these are the links that you can use to already follow and look at this particular strategy. And basically everything that we've discussed for the last previous 4 hours in this series. So you can actually start looking at it if you wish. Again, this is at the John Shealy videos. So that is where a lot of our information is already there. Just come in the Google Drive and you'll find that particular folder. Click on it and you'll see an Excel sheet which has a link by YouTube. All right, let's talk about our things that we're going to see in regards to our room. And I'm showing you a little bit of everything right now because during Ray's sessions, he primarily has what's known as what I would call a trading place, and crude and gold at this particular time. And you're looking at several moving averages. We use tick charts at this particular time. And if you're not familiar with tick charts, a tick chart means that how many ticks are created for each bar. For example, let's just take a look at this gold. We currently are using a 233, but I'm going to show an example of gold at a 144 tick chart. How does it created? After 144 ticks, a new bar will be created. So it's not based upon volume. It's not based upon time. The ticks chart is basically how many ticks are created while the prices range up and above at the highs and lows. That means that bar may only be very, very small, or there at times very large, because it's not even based upon price, it's based upon the price movement in the number of ticks inside that bar. Here you're looking at crude. I am going to show some trades today that's and why there's a difference. I'm showing you right now that the differences are based upon strategies that we use in our room from time to time, and I want to get them so you can see that exactly what we're looking at now. We're using the 233 tick chart. Again, each bar is created not by price, but the number of ticks, and basically the amount of price movement occurs during a 233 number of ticks. Again, guys, that's not volume now. It's not a volume bar. It is not also, though, it is not based upon time. So there's different ways of looking at price movement. Obviously, most of us are basically used to a time-based chart, which is very important to me. I've traded long enough, let's just say over 35 years, and I follow time-based charts a great deal, as you'll know during my time and our sessions. So I follow tick charts and time-based charts, very much so. But as you can tell, it's very, very different than a tick chart. And that's because, remember, they are not based upon time, like a standard 60-minute chart, maybe a 30-minute chart. And that means that the number of prices moves high and lows based upon a 30-minute time period. In a tick chart, no time at all. That could be within seconds. It can be in hours before price moves around. Now, there are different kinds of charts that's also not based upon time-based charts. This is a tick chart. We have, at times, some of our members don't have a tick chart, but they have what is known as range charts. The price movement is based upon the range of the bar. So it's a range chart. There are some members who actually follow what is known as basically a volume bar. It's also not traded versus time. And from time to time, we have some members who follow the Renko chart, which also is not based upon time. It's based upon price movement only. In fact, on my webinar tomorrow at 4 o'clock, I'll be discussing Renko, because Renko is very different than actually a great number of different types of charts. Now you're seeing that we have several moving averages. And I'll talk about the indicators first, but the first thing is look at the moving averages that we have in our chart. This one is an 8 exponential moving average. The yellow is a 34 exponential moving average. 89 exponential moving average, and a 200 moving averages. So generally we use 4 separate moving averages. Now they are all exponential moving averages. But you may want to answer several questions, or want me to answer. Go, well, we say it's 89. Does it really matter if it's 90, 92, 95? No, not really. In other words, it's not has to be that fixed. We use an 89 exponential because it's popular. This is a 34 we use a great deal. And that's because the 34 exponential moving average is very popular. We also use an 8 exponential moving average, but it's primarily we're going to use that for a trigger for some of our strategies. And of course, we'll be discussing that a great deal on Wednesday. How do we use the 8 exponential for some of our trades? Then we have the 89 and 200. As you can tell, they're longer term. The larger period, the larger basically price rise from the lows. And you go, what strategies are generally looking for? When we're discussing this tomorrow, that is Wednesday, sorry, we are generally trend followers. We're looking at corrections within the trend. And if there is a good recognized trend, then we're going to watch prices bounce from the lows, hit the moving average of our interest, in this particular case a 200, and prices then begin to fall down. We would then looking for a short position in the direction of the moving average. And that is generally defined by the slope of the moving average. That slope, you can see that it's relatively flat, but you can see it's still moving down in regards to the 200 exponential moving average. Now you're looking at the 89 exponential, and it's beginning to slope down. So the trend itself is getting more and more bearish. And so our strategies of the trend following strategies is to take these trades in the direction of the quote well-defined trend. We have two indicators underneath. I'm showing the first at the moment. That is the Ray's MACD Platinum. It's MACD, Moving Average Convergence Divergence. How's that for a name? Appel created this a long, long time ago, and why he chose that name, I really have no idea, but that's what it is. MACD, Moving Average Convergence Divergence. The MACD that Ray uses is known as the zero lag, and it's extremely sensitive to price movement. And this is why when you use a standard MACD, you're going to see that it's very different from time to time in regards to the price movement in regards to a divergence, and which I'll discuss a little bit, and of course in much more detail on next week's Monday session. Now, as you're discussing this, I'm showing you at this particular time, again, more and more time in regards to the tick chart. I will tell you right now, in a 233 tick chart, in a crude oil, is extremely fast, that you may look for a trade. It's trying to set up for one of our strategies, pricing hitting into a moving average. You can see that the trend is really bearish, and you may look for a potential short based upon its prices are beginning to move in the direction of the bearish trend. But at times this can be moving down within seconds. Chris, yeah, I'll talk about this. I'll talk about this a little bit. So as you follow this price movement, this is what I'm talking about in regards to a well-defined trend. This is our primary strategies in the direction of a well-defined trend. This is what we wait for. This is what our basically being very patient. That is what we're going to be discussing on Wednesday, is what is known as the 34B. The bounce into the 34, close underneath the 8 exponential, going short because you are selling in a strong bearish trend. Stop losses, profit targets, all set up. Now, one thing I do have to tell you about the tick charts. Different platforms are different. I'm showing you the 233 tick chart. If you use Think or Swim as your platform, the 233 tick chart is not going to match if you're using Think or Swim. Does anyone in our room have the Think or Swim platform? Because what MetaTrader, okay, could be. Some of them, like I say, just depends. Different platforms have different, generally they're pretty close to us in regards to the 230 tick chart, but not all the time, especially Think or Swim. Think or Swim basically kind of captures together ticks, and therefore if you're using Think or Swim, you have fewer number of ticks. All right, you've got Think or Swim. All right, Howard, here's what you need to do in regards to if you're using Think or Swim. You're going to match the number of bars that matches us on, if you're following us in our room on TradeStation. Most of our members prefer in Think or Swim about 140 ticks instead of 233. Somewhere about there. Now you may wonder, how can I really try to match this and for Think or Swim? It's actually pretty easy. Take a chart that you see, and I'm hoping you do on TradeStation when we're in the room. Capture the screen on your computer. If you can, I'm hoping you could print that out. See, I'll show you an example. This is at 8:54. This in TradeStation, between that low and hitting the 34 is 1, 2, 3, 4, 5, 6, 7, 8, or 9 bars. And I'll talk about that in just a second. So in other words, if you want this to match Thinkorswim in regards to the number of bars, you're going to have to decrease the number of ticks. But once you've done that, just count the number of bars that you see on our TradeStation and yours. The whole idea is, and again, guys, but on the basically it should make a difference on ticks. Well, it does in the following sense. By using a 233 tick chart, you're measuring the differences between each close, of course, which is an average, of the 34 moving average. So if I have, let's say I only have 100 ticks in Thinkorswim, I'm not going to have that bounce hit my 34 in Thinkorswim because my 34 is not going to be the same value as when we are in TradeStation. And that would be true in regards to Ninja, etc. So yes, you are going to use the same similar strategy, but all I can tell you is that on Thinkorswim, you may have 34 bounces that you follow us in the room, and you're going to be looking at Thinkorswim and going, well, mine doesn't touch the 34. I need to either change my moving average, or our approach generally is to decrease the number of ticks so that you have the same number of bars. Because if you have the same number of bars between the swing low and hitting the moving average, then you're going to hit them. And Angelo, that's exactly how you're going to do it. That is the same value, all right. Just right. That's exactly right. Ninja is about the same in TradeStation. Actually, the biggest changes that I have seen is the Thinkorswim. So again, most of the traders, anywhere from 120 to 140 in Thinkorswim has the same number of bars between the swings, and therefore they have and hit the same values in regards to our approaches. Peter, before you go here, I will make sure that you get that information, all right? Guys, again, my email is, now saying that, I don't have, all I can tell you, I'm not related anything to membership, but if you have any problem, you send me an email and I'll be sure to always send it to the right person. Again, guys, my email is johnsheely@imadaytrader.com, and anyone would like to come in and send me an email, and believe it, it may take some time, but I always send a reply. Okay? So yes, I absolutely do apply. And to see if this is being recorded. Yes, it is. It is being recorded. And remember, we've already recorded this previously, but of course, while I do this, actually, Chris, that's a pretty good question about CHOP. And before I end the session, I'll be glad to discuss this about how do you avoid this a flat market. And that's basically saying that, Chris, when you are a swing trader in a well-defined trend, which is our trend following strategies, then you're only going to trade when there's a trend. If we have a flat market, we are not trend following traders, and therefore we won't take that particular strategy. Again, that will go again, discuss again on Wednesday in much detail. All right, so the MACD divergence is one of our indicators. We primarily use that. We don't need this to define the trend, like the MACD above or below the zero line. Ray uses the MACD platinum to indicate a change of momentum. Since we're looking at these lows here, and again, we'll be discussing these in regards to, by saying that we have in our PowerPoints, we have a discussion of divergences, and it could be printed out. And the MACD, as you can tell, set a new low in price. But you can see that the MACD is not even close to setting a new low. And that's why the MACD Platinum is very sensitive to indicate a potential change of momentum and therefore a divergence trade. This is known as a bullish divergence. And however, this is going a counter trend trade, which we'll talk about that when we talk about divergence. But I'm just showing you right now that that is the primary reason that we have the MACD. And Barry, on the question, sorry about that. Guys, is there a difference in regards to the information? No, unfortunately, I'll make it even worse, Barry. I'm a very strong red-green colorblind. So there's a lot of times that I have to ask some of you, which color is it? So that is a black. That is a 34. But it's not a reason that it's yellow. It just basically gives you an indication that's a 34 exponential moving average. The white is an 89. And I think that's blue, but I'm not positive that that is a 200 and its color. I'm afraid I'm one of the 5% of men who have a problem with color. The other indicator that we're going to use, let me go ahead and put in this. We have a stochastic. Let me go ahead and switch to a gold as an example. We use two stochastic indicators. I'm going to show two at this particular time. And the reason I'm doing that is some of our members cannot do the same of what we can in TradeStation. In other words, right now we use two stochastics. They are both slow stochastics. The periods that we use is a 21 period, 14, what's known as 1-and-1 in TradeStation. Our other stochastic is also a slow stochastic, a 5 period, 3, 3, and 1. Now, some members cannot put one of the stochastics on top of each other. In our platform, we can. So when you see us in the chart, you're now seeing the difference in regards to the slower stochastic, which is the black, and then, of course, the faster stochastic, than the larger period. Now, they are both slow stochastics. Okay, thanks, Joe. Obviously, we'll cover that before we leave. Actually, I do have the glasses by the guys. Yes, this. Ray uses the, by the way, they are too dark. I've tried that a long time ago, those glasses, but I can see colors, but they're extremely dark. And therefore, and is something else I don't know, guys, if you know about these type of glasses, they work. But they sure are, but they're just really dark, and it's hard for me to see. So let's finish this. On Ray has a stochastic that he uses a private basically a stochastics that is available, but I'm just showing you the general average in regards to what you're going to find on most platforms. And actually, most of the time on the strategies that we're talking about, we're going to be using the fast stochastics. And of course, we're going to cover that in our strategies on Wednesday and the following week. But this is what you're going to see when you're in the room. So we've got a tick chart, the moving average, and the two indicators. I am going to show you now, every once in a while we have a discussion, what's known as the 535 exponential moving average. Now it's a large period moving average. It's 535 in the 233 tick chart. We use also what's known as anchor charts. We use the 610 to get an idea of a larger and longer term period trend. Now I'm going to show you how these two relate. Take a look at the current value of the 610 tick chart. Now we use the same averages. In this particular case, it's a 21, which we discuss from time to time in the room. It's, as you can tell, a little closer to price. That's 34. That's the 89. But I want to show you how these relate. The current price of the 610 is 49.23. Now that is the 34 exponential moving average on our anchor chart called 610. Let's take a look at the price of the 34 at 21 and the 89 in this 233 tick chart. In the 233 tick chart, it's 49.23. Wait a second. That's almost the exact same value as the 34 in the 610. So if you can, write this down. The value of the 610 and the 34 exponential moving average is the same price as the 89 in the 233 tick chart. Take a look at the 610 tick chart. Its value of the 89, 49.26. Take a look at the tick chart now of the 233, And the 200 is very close. That's 49.25. So the reason I'm saying this, you can now look at this one chart, the 233 tick chart. When I'm looking at the 89, I'm getting an idea of what the slope is in our anchor chart at the 610 in regards to the 34 in the 610. When I'm looking at the slope and the price movement in the 233 tick chart in the 200 is approximately the same value as the 610 in the 89 exponential moving average. When we're talking about the 535, these values that you see here in the 233 tick chart, that is the approximate value of the 200 exponential moving average in the 610. That is why you see us from time to time, prices react and bounce into 535. That is looking at a setback in the direction of the bearish trend based upon the slope of the 610 chart. So let's just take a look at it. Look at the slope of the moving average on 610. It's the same approximate value in the 233 at 535. So it lets you know that within seconds, I can look at one chart. If I see the 89 is beginning to move down, that is the same slope in the 610 anchor chart. So I could be bearish. If the 200 is beginning to move down, then that's exactly what's happening in the 610 anchor chart. So this is why when you say when Ray discusses the anchor chart of the 610 in our crude oil and its relationship to our execution chart, which is what we are using in the 233 tick chart, execution. I am looking at the trend, but I'm always looking at the trend of the anchor chart. Now you're seeing now the white candles. And let's take a look at the T1 Super Scalper. Now I'm showing you this because this is exactly what you're going to receive in the PowerPoints of all of our strategies. Now I'm going to be discussing this at the moment, as you can tell, and any of the questions that you have when we review the T1, then of course I'll answer all the questions that you have asked for me. All right, this is exactly what you're going to find in the PowerPoints. You're going to see the T1 Super Scalper buys. What are the rules for us buying? What are the rules for sales? You're going to find the exact same thing in regards to information, the one-by-one rules, basically a step-by-step approach of the 34 Bs, the buys, the sells, etc. You will then have exactly in the PowerPoints set by set in regards to the rules. Our profit targets and our stop losses, where do we place them? I also, for each of these PowerPoints, I talk about enhancing the trade. What additional information I can give to you in regards to make that trade a better trade, or in this particular case, what concerns may I have of whether or not I go long or short using our Super Scalper in this particular trade. And I'm going to show you how to enhance the trade and what are some of the concerns and therefore cancel a particular strategy. And you're going to find this exact same PowerPoint in regards of all of our strategies. So let's talk about what we're talking about in the Super Scalper. You're seeing in the chart a white candle. Now that white candle is not created at exactly the same time when prices set these new lows. They are very similar to what is known as John Carter candles. So we have Ray Super Scalper, our T1 candle. You very well may be able to find that indicator in different platforms. We have some available to you at the Google Drive. At our Google Drive, we have many of our indicators. You can download them. You just go to the Google Drive, TradeStation Indicators, Ninja Indicators, etc. Now, there may be some that we just don't have, but you can be able to find that on Google. Right now, many indicators are now available because unfortunately they have basically stolen the code, and so it's now to the world. And there's actually very few indicators that you can't find in some way. So this is what you're going to see, that the white candles are basically swinging highs and lows. How do I create those, though? I'm going to show in this particular chart here, instead of having white candles on each side, I put a black candle from the price decline, and the white candle is then for prices going up. And here's what we generally look for. See these particular bars that begin to move up. The T1 candle is created by the following. Once you have a close from these highs, you have one down close, and then you have a one tick underneath that low. That black candle is created in my illustration here. But in our chart, you're going to see a white candle on both sides. So again, prices are beginning to move. You have to have a close below the prior bar and a tick underneath that low. On the other side, prices have moved down. We now have a low. Is that white candle created at that second? The answer is no. At that particular time, that candle is still a standard candle. There is no white painted candle. Once we have a close above this candle, and then there is one tick above this high, then is when we have the T1 white candle illustrated and painted in the TradeStation platform. This is the T1 candle that Ray uses for many times of when he's going to use an entry. He waits until the white candle has been created, which means, again, a close above the low bar here and one tick. Once the white candle has been created, he then enters. We are going to discuss divergence on the following week. To enter a divergence trade, he uses a T1 candle. He waits for that white candle. But it doesn't occur again, guys, when it is initially at the lows. It has to move up by a certain amount and a certain amount in regards to the closes. Let's show an example. We see a price bounce, And you can see that the 200 is sloping down. The 89 is still relatively moving down. And here is a close underneath there, the highs. Is that a white candle though? No. On the next bar, did it set a one tick underneath this candle? No. So that T1 candle is still not white. We now have a one tick underneath. Now the white candle will appear. That then, once we see that the T1 candle is now white, which means we have at least price movement in the direction of the bearish trend, now is when we execute and sell. Now, those who use the T1 candle is basically a trigger for an entry. Now, many times, starting on Wednesday, I'll be discussing when we have not the T1 candle as a trigger, but in regards to a close underneath the 8 exponential. And of course, we'll be discussing that on Wednesday. But this is what the T1 candle examines. Now, it's a trigger, but be very, very careful. And some of you have talked about, how do I know whether or not I'm in a flat market? And therefore, I don't want to get chopped up. This is it. Taking a look at the slope of the moving average. This, how flat the 89 exponential moving average is, which is the 89, the white moving average. Absolutely very, very flat. It's so flat that the T1 candles are basically white for a potential bounce in regards to prices moving up. The black, again, is just to show you that it goes in the opposite direction, back and forth. This is how you get chopped up. What are we? Our 34 Bs, 89 Bs, our 200, and we'll be discussing the T2s, T10s, our other trend following strategies. We do not use any of those strategies when the moving averages are flat. That includes a discussion that we will in regards to either late on Wednesday or the first part of next week, what's known as the T20 or T21, which is the crossover moving average approach strategy. So this is the first thing that you understand. And this is all in the PowerPoint and as well as our videos. And now we have created in the Tuesday and Thursday folder a mini, at least 10, maybe 20 of videos discussing our separate strategies many, many times, many examples. One of the things we discuss over and over again is we do not take our our trades in the direction of the trend when we don't have a trend. How do we define that? It is defined by the slope of the moving average. The 34 is relatively flat. We're not really looking for the 34 bounces. But it's really not wanting to take trades when the 89 is flat. You will get chopped up badly. So even if we're looking at our T1s, our white candles, you are not going to take trades what's known as the T1 entry when the market is that flat. You'll just get chopped up. Let me show you the power, however, of the T1. I'm showing again the black candle just to indicate that we're talking about a T1 candle in the direction of the bearish direction. Our charts, of course, would be on white on each side. I just created the illustration to make it black to let you know that is the T1 candle in a bearish trend. The T1 candle is doing extremely well, obviously, waiting for the down close and then a one tick underneath that candle. And the T1 entry is doing extremely well in the direction of the well-defined trend. And that is an example of a T1 entry based upon the white candle, in this illustration of black, in the direction of the trend. This is what we are doing in our game, in our strategy. We're waiting for a solid trend. Once we have a solid trend, it's time to take the trades in the direction of that trend. We're going to use stop losses, of course, and then we begin to use our profit objectives, and of which from time to time I'll be discussing, of course, the different profit objectives that you can use, which we'll be discussing a great deal on Wednesday. But this is the T1 candle. Notice that when you have the T1, and it's back on white here, you're seeing it basically, they go swing back and forth. From the lows, there's the T1 candle in the bullish direction, and then on the bearish direction. Actually, on a time-based chart, that's a good question about the T1 candle. It is generally based, Peter, about using a tick chart of this size. I'm not so sure. Now, saying that, many of our traders can use the same thing, the Carter indicator. I'm not so sure that a T1 candle would be necessarily it could be in theory. I wouldn't use a T1 candle on larger charts. It's primarily using it for fast price movement and a tick chart or a range chart of a small size, small settings. For example, I would not necessarily use a T1 candle of that kind of style in a strategy using it for daily charts. I'm not, in fact, I'm not even sure that I would use one in an hourly chart. It's there's a different way to have a better trade than waiting for a T1 candle in a longer term time-based chart. Again, you're looking for, at times, when Ray talks about a divergence, he's using the T1 candle as the confirmation that the bearish divergence is coming in versus price, new high price versus a lower indicator, and waiting for that T1 candle to appear. Once that T1 candle appears, that is basically setting us up to enter a short trade based upon a divergence. All right, let me ask or answer some of the questions here. Chris, I hope that gave you an idea about how to avoid the chop. Is do two things. See how this 200 is it's starting to flatten out, flatten out, flatten out. So basically, you're not going to trade in regards to trend following. There is no trend. And I generally watch not the 34 as much as the 89. If the 89 is just basically going a little slightly down, slightly up, that's flat. And therefore, I'm not going to take the 34Bs. I don't want to take trend following strategies. Again, all we're primarily waiting for is when we have, this is a well-defined trend, just looking for a well-defined trend. Now, I do trade differently in time-based charts. Ray generally follows the tick charts. Because I have, obviously, like many of you, you have multiple monitors. I follow our time-based charts. And Chris, the other thing is, John, how do I kind of ignore some of this chop? Take a look at, this is a 15-minute chart. Look at this. This price movement is 2 to 3 hours sideways. How do I avoid getting chopped up? Take a look at the 233 tick chart. Follow the 610 anchor chart. But we need more information than that. Then look at the 15-minute time-based chart, and it's going to give you a tremendous amount of information. Primarily on, is there a good trend or not, based upon a larger time period. It's not just 15-minute. When you see me in my trading, I generally go back and forth. At the beginning of the day, I start with a 2-hour chart. What else do I do? The daily. I start each commodity by looking at the weekly and the daily in regards to the trend. What are we using it for? Well, A, to find the trend, but it's also the previous support and resistance. I can't find that in a 233 tick chart because the 233 tick chart is relatively small. So I need to look at what may concern me in regard to taking a trade, in regards to previous support or resistance. Well, I need that information in regards to the daily, the time-based charts. For example, what do you think prices are going to do over the next 24 hours? Well, take a look. We've had 1 down close, 2 down closes, 3, 4, 5, 6. 6 down days in a row. It might be 7, but you got to be kind of careful over the next 12, 24 hours because there may be a bounce just because we've had a great deal of oversold price action. We'll be discussing this a great deal, is to look at our time-based charts to get an idea of when prices are basically getting set up for a larger bounce. And I'll be discussing this on Wednesday, how to avoid many of these losses that can occur when you are taking a trade in the direction of the trend. And I'm going to be discussing that a great deal of how can I avoid some of these losses from time to time, because there's always going to be corrections from time to time. And if I take every trade in the direction of the trend, eventually I'm going to have a larger correction, and then I'm going to get stopped out. So I'm going to be discussing it with you quickly about how to avoid some of these losses. Take a look at the price action here in the last 5 hours. Look how flat in a 60-minute chart is. That, goodness gracious, I need to be slowing down my price action, even if it's a 233 tick chart. So you can see what I'm saying is, how am I going to help myself trying to avoid losses? You look at it. There it is, right in front of you. Time-based charts. And I'm going to show you how to do that. Because a lot of times you'll see some of our members saying, I'm going to take this trade and I'm going to take that one. And I'm going, I don't think so. I don't think so. Because I'm looking at time-based charts. A good question here, Joe, in regards to guys, when markets begin to move, Let's talk about this. Actually, let me put this not on the 233, but of course we're going to be doing this a lot on Wednesday. I just wanted to show you what charts we have, what charts we use, and the T1 candle. We're really going to get into this big time on Wednesday. Let me move back a little bit. It really starts with, again, a time-based chart. Now this is the 610. During the next 3 sessions, I'm going to be talking about the speed of the 233 tick chart. It's fast. If you are new to trading, I'm telling you, that may be too fast for you to execute very quickly. Trading is not easy, and trading in short-term trading is very difficult as well. Many of you have already had a different career probably for trading, and it took years and years of experience. Well, you're going to need some experience too in regards to trading. I'm going to give you the experience as fast as I can, but it's going to take some time. It's very difficult to take a trade within seconds, if you're new to trading. I want to help you by slowing you down. I want to be discussing a great deal about taking the trades in the 610, not the 233. Now we're going to execute a lot of trades on the 233, but if you're having any difficulty of it's just too fast, then don't worry about it. John says, it's just too hard for me. Don't worry, I'm going to show you how to use a 610 to do the same trade, use the same strategy, but we're just going to use a larger tick chart. So we have more time to take the trade. For example, this is a bounce into the 89 in the 610. Now, because it's a 610 chart, I have more time of waiting for each one of these little ticks here. So I can use that entry using the exact same strategy, but using it in a 610 chart. Now notice that you get the rules. I know where the stop losses are. And you can see this big fall because you're using a larger profit objective because you're using a 610 tick chart. So I'll get you there. If you're having difficulty in the 233 tick chart, I'm going to show you how to use a larger tick chart, the anchor chart, to actually execute the trades. In regards to this, I'm showing you the highs here to start, guys. So we're talking about we are early, it's basically the early stage of the trend. That's actually when we want to start making our money. We don't want to be too quick because we don't know whether or not we are turning into a bearish trend or not. You now see that prices are beginning to move. The 34 is now sloping down. It's the early stage of a potential change to a trend because we were in a bullish direction at first. Prices are beginning to move down. The 89, the white one, is beginning to also move down. Correct, Peter. Let me answer that. I'll answer that in just a second. So when that begins to occur, that the little bounce right here, guys, is hitting the 34 exponential moving average. That trigger is right here for a sell. It is early in the trend. It's finally having a bounce, and it's then getting into the what's basically the meat of the trend. But this is the early part of the trend. That is when you really want to focus on making sure you get these trades. Not in a flat market though, But when the moving averages are all moving down, you're at the early part of the change of trend, and we're basically getting all set up for the balance of the day. Let's talk about a little bit more information about the early part of the trend. This is going to help me as well. This is a 30-minute chart and then a 15-minute chart. You can see in this particular, this is today. This is the crude, and it bounced up. And of course, I'll talk about the differences of moving averages. And as you can tell from yesterday, all this price movement is beginning to move down. Now take a look at this area right here of the chart. It's at the early stages to a change to a trend in regards to a bearish direction. This is when we focus on our 233 tick chart, our 610. But my 15-minute chart helps me say, wow, they're really both going in the same direction. The 15-minute chart is beginning to fall down. It's now beginning to fall actually for the last hour. And you think, well, is it over with? Oh, no. We're just getting started. And so you're seeing this big price fall and basically a couple of hours. And then you put all of this information together. I got a 15-minute chart starting to go down. I now look at the 610, the 233, and I found an early trade in the direction of the trend. It's time to trade. Any other questions here, guys? I'm trying to go through it. Make sure everyone has that. Like I say, we're just starting. We are really going to get into it on Wednesday. Yes, you can use the, yes, Benny, you can use the 144 tick chart. We use that for the following. 144 tick chart in gold. We're going to use that in regards to the Euro, EC. We're going to use the 144 in the YM, the $5 Dow. You can also use that for the yen. We use in the ES, the mini, a 550 tick chart. I can't right now. I'll be glad to. On the questions that I had for today, I actually had quite a few, and I'm way late. So I'll be glad. Now, saying that, I'll be in the room tomorrow, so I'll show the trades that I did today and tomorrow. So don't worry about that. I'll show you exactly everything that I did today. So hopefully this is going to be very helpful. Send me an email, and I'll be glad to. Again, can you? You'll be able to have my email. Send me an email. I'll give you the information that you just send it to me. I'll be glad to do that for you. Now, saying that, I have a lot of I have trades all over the place. I traded FOREX, gold, crude. I did not trade the stock indexes today. I didn't take any trades in the stock indexes. It was because of the big gap in the SPY. Oh yeah, I was definitely. Ray was negative because it was because of the flat price movement here. Actually, you can see you can generally tell if you have trouble as a trend follower. If you have this kind of flat market, let me tell you something. You're having difficulties. But I'll be, like I say, just send me an email. I'll be glad to give you the information that I have. All right, guys.